Question 2B of the December 2024 paper in the subject Basic Finance as examined by the Zambia Institute of Marketing required students to prepare a statement of financial position. A required students to prepare a statement of profit or loss, and that was already done. If you have not seen the video, I'll put the link in the description. In this particular video, I'm going to show you how students could have attempted part B, which required students to prepare the statement of financial position. We start by putting the name of the account, and the name of the account is Bwalya Kabuswe. Kabuswe, like that. And what is it that we're preparing? We're preparing the statement of financial position. (2024), 2023, you can always just verify, but that information is given and that's what you're going to put. So the statement of financial position, as you may already know, is what previously was known as the balance sheet. And the balance sheet basically comprised of three areas: liabilities, assets, and equity. Liabilities, assets, and equity. So we are going to start with assets. Let's start with assets. And assets, remember, there's non-current assets and current assets. Non-current assets are those that the business expects to use for more than 1 year. So we need to clearly indicate the current assets. Clearly indicate current assets. Okay? And our current assets in this particular case include inventory. Remember that? Inventory. We're given this information, and the value for inventory is 24,800. The value for inventory is 24,800. We also have trade receivables. Trade receivables. Oops. Spelling for receivables. And the value for trade receivables is 4,300. 4,300. Let me just correct the spelling for trade receivables. Okay. Should be like that. And the value is 4,300. What else? We have rent prepaid. Rent prepaid. And how much was it for our rent prepaid? Rent prepaid, we are told that it is 8,600. 8,600. The other asset, current asset, is cash, and the value for the cash is 17,200. 17,200. So these are our current assets. Let's give them a total. Okay, total current assets. Okay, total current assets. And what does this give us? For the total current assets, this gives us 54,900. 54,900. Then there is also non-current assets. Non-current assets. Okay, non-current assets. And the non-current assets that we own in this case include equipment. Okay, include equipment. Equipment. There's equipment, and then there is also motor vehicles. Motor vehicles. Now take note. All right, we need to indicate the cost. Then we also need to indicate the accumulated depreciation. The accumulated depreciation. Okay, let's just say accumulated depreciation. Okay, just write it in short like that. And then the residue, which is the net book value. NBV stands for net book value, meaning what remains. So let's just create some space here. So these two are our non-current assets: equipment and motor vehicle. The value for equipment is 90,000. The value for equipment is 90,000 kwacha. And then remember, there is depreciation that applies here. There is the depreciation. After we've depreciated this particular equipment, what does it give us? After we have depreciated this particular equipment, it gives us 22,500. 22,500. It therefore means that the accumulated depreciation would be the difference of these two. Accumulated depreciation would be the difference of the 90,000 kwacha less the 22,000 kwacha 500. And that's going to give us a value of 67,500. When it comes to the motor vehicles, the cost or the value for the motor vehicles, we are told, was 120,000. 120,000. The accumulated depreciation is 62,400. Now, when we subtract the accumulated depreciation from the cost, it's going to give us our net book value. And our net book value is 57,600. 57,600. So let's just give these their totals. That's the total for that one, 210,000, and this is the total for this. It's 129,900, and the total for this is 80,100. This 80,100 is the value for our non-current assets. Non-current assets, and the value for current assets is this one. Okay, and the value for our current assets is this one. So we need to then indicate what our total assets are, the value for our total assets. Okay, total assets. All right, the value for our total assets is going to be this one, that amount over there, okay, plus this amount over here, which gives us 135,000 kwacha. 135,000 kwacha. This is the value for our total assets. This is the value for our total assets. Let's move on to liabilities. Liabilities, okay? And just like assets, liabilities are also categorized as non-current and current. Non-current and current. So let's first list our non-current liabilities. Non-current liabilities. Our non-current liabilities include a 20%, the loan that we got, okay? So that's 10% loan, okay? The 10% loan that we got, and the value is 20,000. The value is 20,000 kwacha. All right. So this is the only non-current liability. So now let's turn to current liabilities. Okay, current liabilities. All right, and current liabilities, we are told what we include on the list as our current liabilities. There is trade payables. Trade payables, and the value for trade payables is 8,400. 8,400. Then we have a bank overdraft. Bank overdraft. Okay, bank overdraft, and the value for the bank overdraft is 5500. 5,500. 5,500. Then there's wages and salaries. Remember, they accrued. Wages and salaries accrued. Okay, and that brings us to how much? We were told that this was 21,000 kwacha. 21,000 kwacha. Then there's interest, the interest to the loan. Remember that? So loan interest. It was a loan interest of how much? 10%, which therefore means that our loan interest liability is of 2,000 kwacha. 2,000 kwacha. This gives us our total liabilities. This gives us our total liabilities. Okay, just write it there. Actually, you can just write it there. Total liabilities. Okay, total liabilities. Total liabilities is these put together, non-current and current liabilities, and this gives us a total of how much? It gives us a total of 56,900. So our liabilities are 56,900. We now turn to equity. Okay, financed by. Okay, financed by. There's the capital. We need to take note of the capital here. And the capital, how much for the capital? For capital, the value was 57,600. 57,600. We add net profit. And the net profit is found in the statement of profit or loss. And the value for the net profit, remember, was 32,300. 32,300. Then we less, okay? We less drawings. Less drawings, okay? Drawings, the value for drawings was 11,800. 11,800. What does this give us? These three, when we add them together, when we add these three, it gives us 78,100. 78,100. We are done, but we need to confirm if this is correct. And to do this, we apply the accounting equation. The accounting equation is assets is equal to capital plus liability. Assets is equal to capital plus liability. So our value for assets is 135. Okay, we've settled that. How about our total liabilities? Our total liabilities are 56,900. Fine. And our capital or equity is 78,100. The sum of our equity, this one, 78,100, when we add 78,100 to 56,900, it must give us 135,000. If it does not, it means that something is wrong somewhere. If it does, it means that we are correct with our answer, and then we can submit. So the accounting equation is that the total assets, the assets, is equal to total liabilities plus capital. So when we add this 78100 to the 56900, it must give us 13500, and it does give us 135,000.